Hey everybody, and welcome back to the second video on non-bank financial institutions. In today's video, we're going to move from investment banks to a different set of investment institutions, namely mutual funds, ETFs, hedge funds, and finance companies. So, you may have heard them referenced quite a few times, but may not be quite sure what they are. Mutual funds are extremely popular and well used, and they're just a financial intermediary that raises funds by selling shares to individual savers and invests those funds. And there's two types of mutual funds. There are closed-end mutual funds and open-end mutual funds. And really, the difference between them comes down to how you can trade your shares in the fund. In a closed-end mutual fund, the mutual fund will issue a fixed number of non-redeemable shares that can be traded on the market just like a stock. And the price of a share in the mutual fund will fluctuate based on the market value of the entirety of the fund. So, in other words, the assets that it holds. So, that means that just like any other company, the mutual fund will offer its shares on the market, use those funds to invest in assets to make the fund better, just like any other company. The only difference is that instead of investing in goods or services, they're investing in these financial assets. Now, an open-end mutual fund, on the other hand, will issue shares that investors can redeem after the market closes for a price that is tied to the net asset value, so the total value of the mutual fund based on how the market closed for that day. And within this, a mutual fund is defined as a no-load fund if it does not charge commission fees. However, with any mutual fund, there are always going to be management fees, and that's usually at about 0.5% of the total value of the investment in the mutual fund. Now, one of the big reasons why mutual funds have become increasingly no-load funds is because of the growth of ETFs, or exchange traded funds. And what an ETF is just a portfolio of financial assets that investors continuously trade shares of during the day. Now, you might be like, hold up, why is this any different than a closed-end mutual fund? And I'll explain that to a second. But the reason why ETFs became so big in the first place was because of the worst single day drop in the Dow Jones and the stock market as a whole on what is now called Black Monday, which is October 19th, 1987. The Dow Jones Industrial Average dropped nearly 23% in one day. And to give you some context about how severe this drop was, the second worst drop in the Dow Jones history was on March 16th of this year, which was the worst one-day drop in the 2020 COVID-19 recession. And on March 16th, the Dow dropped just under 13%. So we're talking about, think about all the panic selling that was going on in mid-March as everything was locking down. Nobody knew what was going on. Nobody knew the severity of COVID-19. Think about all that panic selling and then double it. That's how bad Black Monday was. And with the investors in open-end mutual funds, which were the dominant type of fund in 1987, those investors were really upset because as the market's crashing, they couldn't sell their mutual fund shares. They couldn't trade it until after the markets closed at the end of Black Monday. And think about if you're an investor, while it's probably good for the market as a whole because these open-end funds prevent panic selling at least during the day while trades are occurring, uh, it means that from an investor side, it's really scary as you're just sitting there and just listening to returns from the Dow Jones, and every single time you hear an update, the market has fallen even further. So ETFs started to grow after this happened because they are just traded strictly like a stock market or a stock on the stock market. And one of the reasons why it's so easy to trade an ETF is because they're not actively managed. Instead, what they are is a large portfolio of investments that track some very clear-cut strategy and don't deviate from it. So a couple examples are like the S&P 500. You could just invest in tech stocks on the S&P 500, just like the large cap stocks like the S&P 100 or Fallen Angels, which are my personal favorite ETF because those are investments into junk bonds that were issued at the time when the company was investment grade and is now trying to recover from it. Just as a little anecdote. But so rather than a mutual fund having a bit more of like flexible strategies and being actively managed and having stocks constantly being put into the portfolio and being removed from the portfolio, the ETF just stands true with its portfolio of stocks, and then those shares just get traded alongside the market. So what prevents somebody from trading in the ETF and making extra profit? What ties the ETF to the S&P 500 or whatever sector it's tracking? Well, it's because ETF shares can actually get traded back in exchange for that proportion of the total portfolio of an ETF. So let's say you own 0.01% of Vanguard's S&P 500 ETF. Well, you could trade that 0.01% of the ETF's value and in return get 0.01% of the total market share that Vanguard's S&P 500 ETF holds. So, it gets broken down based off of the individual stock value. And because of that, if there's any discrepancy between the ETF and what the underlying market or whatever it's tracking is worth, there could be massive arbitrage profits. And so the fact that arbitrage profits could hypothetically exist is what keeps ETFs really closely tracking what they are saying that they're doing. Additionally, ETFs have zero commission attached to the trading since it's done on the market. Now, the ETF manager may, or the platform that you're buying the ETF through may require commission, but the ETF itself, if you just go to like Vanguard and buy a share of their Vanguard S&P 500 ETF, they would not charge you any commission. And so because of that, ETFs are a great way for people that don't have a large investment portfolio to track these like indexes as opposed to mutual funds, which do require commission fees. So that's why like the growth of apps such as Acorns exists, is because ETFs are considered like a low cost reciprocal of mutual funds. Now, additionally, within mutual funds, there is a subclass called money market mutual funds. And these are just mutual funds that exclusively invest in short-term assets such as treasury bills, negotiable CDs or certificates of deposit, and commercial paper. And commercial paper is a short-term corporate debt, so it's the corporate version of a treasury bill. Now, prime money market funds are even a subclass of money market mutual funds, and they exclusively invest in just commercial paper. And what that ends up meaning is that prime money market funds actually compete with commercial banks for the issuance of short-term corporate debt, because prime money market funds can actually oftentimes charge lower interest rates and be more flexible with duration. And then, but because of that, there are a couple drawbacks on relying on just commercial paper, even though it can be quite profitable. And the 2007 crisis really exposed these problems. Uh, in 2007, prime money market funds had a lot of problems, mainly because they couldn't issue new paper. The reason for that is pretty simple, that no company wanted to start investing and growing during the financial crisis. On top of it, one of the biggest issuers of commercial paper through the repo market were actually large investment banks. And if you remember, like Lehman Brothers, Goldman Sachs, they're all going under. They're not issuing more debt. They're not trying to finance new transactions. They're not taking on more liquidity. And that means that the commercial paper market that they are really fueling is just drying up. So these prime money market funds had no commercial paper to invest in, so they weren't getting the profits that they needed. Additionally, The interest rates that were being charged by the prime money market mutual funds didn't actually value the risk that commercial paper posed correctly. Broadly speaking, they issued these commercial paper as if it was almost treasury level returns because they figured in short duration there's no way, Amazon can't pay back a 90-day uh, debt, a 90-day commercial paper. Well, while that may be true for like Amazon, they didn't proportionately increase the risk associated with riskier firms. And so that meant that they actually brought on a higher default risk than they realized, when in reality, the commercial banks may have been pricing the required interest rate to take on the commercial paper a little bit more accurately. Additionally, there are other issues related to the commercial paper market that COVID-19 also ended up showing. What ended up happening during COVID-19 was that money market funds were extremely exposed as the commercial paper market dried up because, once again, no company started expanding during the COVID-19 pandemic and for a lot longer duration than 2007. So what ended up happening, investors started trying to cash out of their money market mutual fund shares. So money market mutual funds were having a liquidity crisis. At the same time, they were having a little bit of what like could be considered a bank run, meaning that mutual funds were actually more exposed to long-term risks in the because of the COVID-19 pandemic than investment banks. And so what ended up happening was they actually went to the investment banks because the investment banks, they had a more diversified portfolio, partially because of post financial collapse decision making and risky decision making. But because of the financial collapse, large banks also couldn't take on excessive debt and issue commercial paper. But as I mentioned, this was one of the main sources of commercial paper for the money market mutual funds. That means that the money market mutual funds came begging to banks like JP Morgan Chase. But JP Morgan Chase couldn't issue more commercial paper. And so the market completely froze up. And to respond to keep these money market mutual funds, especially afloat, the Fed actually had to revive its commercial paper funding facility to directly purchase commercial paper from these money market mutual funds. So mutual funds were propped up through these cyclical, very short duration commercial paper loans coming from the Fed and just going over and over and over again. And now the Fed is starting to try and wean these money market mutual funds off of it as the market returns back to normal. Now, a hedge fund is different from a mutual fund. A hedge fund is a financial firm that is organized as a partnership of wealthy investors that makes high risk speculative investments. And so these are closed funds. You can never buy shares of hedge fund on the stock market, and they usually have less than like 100 investors. We're talking like, 20 or 30 investors at most in a hedge fund. So because of that, we're talking about like the wealthiest 1% of clients in the US are those that invest in hedge funds or large institutional investors like pension funds. And we're going to talk about pension funds more in the next video. But on the flip side, since they're so exclusive, they're also very loosely regulated. But what we do know about hedge funds is that there's about $3 trillion in assets controlled by hedge funds, and there's about 10,000 of them right now in the United States, of course, give or take a bit. But what these hedge funds do is they take on very high risk by investing in more speculative or risky strategies that usually include shorting stock and buying futures contracts on the security or the underlying asset that you're banking on to hedge your risk. Hence the name hedge. It's because of this simple hedging strategy that they became infamous for. But they are quite controversial, and that's really for 4 or 5 main reasons. The first one is that hedge fund managers receive fees and then shares of any profits. However, on both of them, they only pay capital gains taxes rather than an income tax rate. So it's a bit of debate whether or not hedge fund managers should be paying the income tax rate or the capital gains tax rate, because there's a huge discrepancy, especially when you consider the income level that hedge fund managers are at. To give you an idea, the capital gains tax rate, we're talking like 12%, whereas we're talking about the income tax rate of closer to like 30 or 40, depending on how profitable the fund is. Additionally, investments in hedge funds are extremely illiquid. Usually, when you enter into a hedge fund, you sign a contract that says that the funds that you invest into it are tied up for between 1 to 3 years, and then you get only a couple weeks to pull out your money in the hedge fund before you get tied down again for another duration period. Otherwise, if you do pull out, they'll just replace you with somebody else. On top of this, hedge funds pose massive threats to financial markets if they experience losses. And this is a really famous example. You may have heard of the Black-Scholes-Mertens model, which is a options contract pricing model that one Myron Scholes and Robert Merton. Black unfortunately passed away, and you can't receive a Nobel Prize post-mortem. But Myron Scholes and Robert Merton both won a Nobel Prize for this options pricing formula, and they were using this formula to actually run a hedge fund. Well, the fund nearly went bankrupt while holding $1.1 trillion in assets, which brought up two problems. First, uh, it would be massively problematic for a fund controlling over $1 trillion of the US economy and financial system to go under. Additionally, it makes you wonder whether or not they actually deserve the Nobel Prize. But because of the structural integrity that the hedge fund going under posed, they worked with the Fed to get a short-term liquidity deal to help prop up and stabilize their hedge fund, and then they unwound a lot of the assets that they had. Finally, and this is one of the most hotly contested ones, is that hedge funds short sell a, a lot, very heavily. They short sell, and that leads to a little bit of an integrity question, because that means that hedge funds oftentimes are betting against the US economy. And if large, powerful funds are betting against the US economy, you probably think that they're trying to use their influence to drive down the economy so that they can make a profit, which is, of course, a massive moral hazard problem. But additionally, just ethically and morally, it's quite questionable to do that. You think about the people in The Big Short, in that movie, it's questionable what they were doing, and there was a scene at one point where they actually came to terms with realizing that they're betting on the entire world economy falling apart. Additionally, lastly, hedge funds operate outside traditional SEC regulation, which is hugely problematic, as well as it means we don't really understand the full scope of the risk and exposure that hedge funds pose to the larger integrity of the US economy, which is why it was so important to bail out like Scholes and Merton's hedge fund. Additionally, that means that we don't really understand the size, scope, and risk that each hedge fund has. And they also don't really track the stock market very well. A hedge fund that is run by John Paulson, who's one of the most famous financiers in the world, it actually made $15 billion in the financial crisis because he invested in credit default swaps. So he was another one of the people that took the bet against the housing economy along with those in the Big Short. However, he then invested into assets that were tied to strong economic recovery in the US. And if you remember, it actually went quite slow. And so we ended up losing 35% of the fund's value in about a year and a half. So these hedge funds, we don't understand what they're investing in, and they really don't track the economy super well. So it's really difficult to pin down the exposure that we have to them. Now, you might be like, well, why haven't we, tried to regulate them more. Well, the Dodd-Frank Act, which came up in 2010, and we're going to talk about more in depth in chapter 12, it requires hedge funds to at least now be registered with the SEC so that the SEC at least knows that these hedge funds even exist, but they don't need to disclose their positions, their holdings, or especially their trading strategies. So the movements within these hedge funds is still not really known. And that was despite a couple attempts to get some sort of this legislation or language into the legislation, into the Dodd-Frank Act, but it always failed. Now, lastly, we're going to talk about finance companies. And finance companies are just a non bank financial intermediary that raises the money through sales of commercial paper and other securities and uses these funds to make small loans to households or firms. And first, they're usually not really tightly regulated since they don't accept deposits. They're not like checkings and savings accounts and stuff. Uh, Additionally, they don't necessarily pose the same scope of risk to the U.S. economic system. So, like agencies like the SEC aren't quite as worried with finance companies. So what they do regulate is fraud prevention, and then you have to disclose who potential borrowers are. And there's three main types of finance companies. Uh, First are consumer finance companies, and these are a lot of the companies that make loans for small purchases like cars and furniture. Business finance companies will purchase accounts receivable from small firms at a discount. What we mean by purchasing accounts receivable, for example, anytime that a company makes some sort of like IOU or accounts receivable request, there's a probability that it defaults on that. Well, as time passes, the probability that the accounts receivable gets paid off declines. So business finance companies will purchase the accounts receivable at a discount so that A, the small business can get the accounts receivable off its books and not have to worry about it, and B, get it a little bit more cash. But it's beneficial to business finance companies because when the accounts receivable gets paid off, assuming it does, they'll make a profit because it was sold to them at a discount. Finally, are sale finance companies, and these are just intermediaries that issue credit cards for large companies. So if any of you have like a Target card or like a TJ Maxx card, they actually are using what are called sale finance companies, and these companies will then pass on a percentage of the profits to like TJ Maxx or Target or whatever.